going to start today by introducing our panelists, and then they've actually prepared the discussion for today. So instead of moderating, I'll be stepping down the picture. Today we have Dwight Clemens from Small Business Alternatives. Dwight, go raise your hand. Ed Chamberlain from 1040 on Wheels, and Jim Lowe from ABL Tax Pros. So, gentlemen, if you would like to go ahead and get started, it's your show.
Okay.
And please speak as loud as you can today.
Okay. My name is Dwight Clemens, and I'm president of Small Business Alternatives. We're a tax and accounting firm in town. I want to thank Choya for inviting us to be on the panel. I'm a local guy. Went to Asheville High School, graduated from Davidson College, met my sweet wife Martha there, and talked her into moving back to the mountains. We have two lovely daughters. Molly is a nurse at Duke Hospital, and Susanna and her husband Craig Justice. They are attorneys with Van Winkle Law Firm downtown. They have our two grandchildren, Aiden and James. We started Small Business Alternatives back in 1985. We've worked with individuals for tax purposes. We handle all levels of individual taxes. We work with small businesses in the area. We've been very fortunate to work with small businesses that are in their infant stage, help them develop bookkeeping systems and bring them up. Hope to bring them to maturity and make them successful. We've also been successful with more mature businesses who maybe have reached a fork in the road where they need a little bit more help. But anyway, we thank you all for coming, and I hope you enjoy the presentation.
My name is Edwin Chamberlain. I'm with my own company, 1040 on Wheels. I do taxes for individuals, small businesses. Most of my clients are either high wealth individuals or business owners. I want to tell you a little bit about the enrolled agent designation. All of us on the panel are what is known as enrolled agents. That means we can, like tax attorneys and CPAs, we can represent you in front of the IRS or any other income taxing agency in the United States. Our license is nationwide, whereas a CPA or tax attorney is licensed by their state and perhaps has reciprocity with a few adjoining states. But anyway, the enrolled agent designation is actually older than the Internal Revenue Service. The first enrolled agents were able to help people who had claims for damages done by the Union Army in the Civil War. Anyway, without further ado, we will move into the presentation.
I guess I'm next. My name is Jim Lowe. My wife and I own ABL Tax Professionals on Sweeten Creek Road. I've been in the tax business about 20 years, and our focus is mainly individual, corporate, and business partnership tax work. We do some accounting, but mostly tax work. Has anybody heard the term fiscal cliff?
No, what's that?
Has anybody heard of the Bush tax cuts?
Yeah.
I think everybody has. Well, we wanted to talk to you a little bit. Obviously, you watched the news this morning and last night. We still don't know. You came up to us and asked us, well, what should I do? We're still going to sit here and go, oh, we don't know what to tell you to do, really. But we have some thoughts about what you might consider doing before the end of the year if you have time. And then also, if these issues are not resolved, what your tax situation might look like in 2013. So, one of these a quote I love when we talk about our profession. I'm sure that my cohorts here will agree, but we always we avoid the words always and never when we talk about taxes, and we use the word maybe and it depends. So if you ask us a question we may say maybe, or we may say it depends. And that's because all of our tax situations are unique, and so it's difficult for us to just give you a blanket answer. But anyway, with that said, we wanted to ask y'all a couple of questions. How many of y'all own or business owners? How many of y'all are sole proprietors? Partnerships? S corporations? Okay, great, that's good. How many of y'all have children under 17? Good. Okay. How many of y'all have children in college, or you're in college? Okay. The reason I'm asking those questions is a lot of these changes pertain to different subjects. So anyway, what we're going to do is we have three different questions that we're going to try to help answer. And the first one's going to be, what are the major Bush tax cuts that are going to expire? And of course, y'all have your little 2-page handout there. You can just kind of follow along. Then we're going to talk about what other provisions are expiring. There were a ton of stimulus bills that were passed, over the last 8 years. A lot of those provisions are also expiring. So we want to let you know some of those that have already gone and some of them that are going to go. So anyway, I'm going to start with the first one. We're going to look at the major Bush tax cuts that are expiring at the end of 2012. Y'all know that our tax system is a progressive tax system, meaning your taxable income is first, right now, being taxed at 10%, then 15%, then it goes up and up. And of course, you've heard about the 36% going to 39%. You've all heard all that. The first thing that's going to expire is our 10% tax bracket that we've enjoyed for a while. And so, for instance, how many of y'all are single? A couple single people? That would mean about $448 to you, give or take. Just if it expires, assuming you have taxable income. And a married couple would be almost $900. And that's just one. And y'all heard them say that average family is going to pay about $2,200 more. That varies, but that's part of the calculation right there. So if these are not extended, then the first tax bracket in taxable income is going to be 15%. We lose the 10. That makes sense to everybody? Well, it doesn't make sense, but smile or be louder?
Just louder.
Louder. I'm trying, man. I don't have any left in there. All right. Okay. Everybody knows what a capital gain rate is. If you sell stock, if you sell a piece of property, and you qualify, most rates the rates were either 0, depending on your income bracket, or 15%. This one's going away. I don't know what my buddies here think. I don't think this one is coming back. I'm pretty sure that we'll be looking at 10% for lower income and 20% for higher income. And when we're talking about higher income for the 20%, we're not talking about people earning $200,000. We're talking about much lower than that. So I think we're going to talk later. If you're thinking about selling something, you might want to do that. I think one of these guys are going to discuss that. Also, are y'all familiar with what a dividend is? And if y'all have stocks where it pays you a dividend, dividends have been enjoying the capital gain rate for the last number of years, and I believe this also expires and they'll be taxed at normal rates, so you won't get that 15%. Okay, does anybody have kids in daycare? No, I'm going to skip that one. All right, anybody have children under 17? Okay, a lot of those. All right, you know how nice that is to see that $1,000 child tax credit on your tax return. And if you've got 2 kids under 17, it's $2,000. If he's got 4, it's $4,000. Woo! That's a refundable credit. Even if you can't use it, a good portion of it can be refunded back to you. That drops to $500. So that's going to be a real killer, I think, for a lot of families that have become accustomed to that. Now remember, when we're talking about these things, you still have all this for 2012. We're talking about 2013. So I think that's it for me. I don't know who's next.
I'm next. First thing I want to briefly mention is the earned income credit, which is a refundable credit. That just means that unlike most credits, it keeps helping you even after your tax is reduced to 0. very nice credit for lower income individuals, but I expect that all of us are at least trying to get out of having low enough income to qualify. Next, I want to briefly mention the adoption credit. We're talking about adopting a child. Shelter animals do not count, but foreign children do. Key number for the adoption credit is $13,360. You can shield that much income from tax if your employer pays it to you for adoption purposes. You can also, if you have another $13,360 in expenses that you pay out of pocket, you can get a credit. Used to be refundable last year, never had been before last year, I don't believe, and it's no longer going to be refundable. So anyway, that goes. How many of you have heard of the marriage penalty? Yeah, everybody. Basically, it started in 1969. Congress felt that married people were getting too much of a break in terms of the tax rates, and golly, did they fix it. Also, in terms of marriage penalty, if you have children and are not married, one person and are taking the standard deduction, one person can file head of household and the other person can file single, and they'll have a larger combined standard deduction than if they were married filing jointly or married filing separately. So that's another little feature. The tax rates were fixed in 2011, but that's set to expire if nothing changes, and we'll be going back to, I believe, 2009 marriage penalty-like rates. So have fun with that. For most of my tax career, there was a limit on itemized deductions. In other words, if you had more than some amount of money, for example, for a married couple, $166,380, then you didn't get all of your otherwise allowable itemized deductions. And then they took that away, and it's set to come back if nothing changes. So for those of you with extremely high income, married filing for 2009, married filing separately had to be above $83,400 to qualify for this loss, and any other filing status, including single, $166,380. So if your income, if your adjusted gross is above those figures, watch out. You may lose your itemized, some of your itemized deductions. And I believe it's your turn.
We all know what a personal exemption is. That's on the second page of our 1040, and that means that everyone in your household is eligible for a $3,500 approximate dollar deduction. That has been, like Edwin said, there's been certain income limitations. For a single person, it used to be that if you made more than $166,000 or married filing joint more than $250,000, you start losing those exemptions. Just like the itemized deductions, with the economy, Congress made that go away in 2010. We've enjoyed full exemptions for a couple of years now, but if Congress was nothing, that will go back. We will lose part of our exemptions if we lose those limits. How many have student loan interest for yourself or your children? That's That's of course always been on the front page of the return. Get to again subject to certain income limitations, but you can deduct the interest that you pay on college loans. In the beginning, you could only deduct that interest for the first 5 years that you were repaying the loan. Then after that, you just paid it. Well, that went away, and we've been able to continue for a number of years under those tax cuts, deducting that. If nothing happens, that will go away. If your college loan for your child is more than 5 years old, no deduction. So you can see how when they say taxes are going to go up on everybody, it's not that they're always raising the rates, but it's all these deductions that are just going away. The estate taxes, of course, that's the death tax, and that exemption, the value of your estate has been increasing each year, and it finally got up to over $5 million. But again, if Congress does nothing, it goes back to $1 million. That means if your estate is over $1 million in 2013, then the taxable amount of that estate will be taxed at 55% versus what it is currently in 2012, only 35% of the amount that exceeds 5.12 million. So again, we don't wish anyone to die. They need to die this year. Well, they're gonna die. Save you some money. The gifting. Now this, we'll talk more about this later in tax planning, but the gift tax rules follow these same exemptions that the estate does. So again, if you're going to you have a sizable estate and you're going to give money away, give it away this year.
Yes.
Okay. Now we're going to move on to that was the Bush stuff since 2000. The rest of the ones we're going to talk about that are either gone or going were from numerous stimulus packages that were passed. And I've also heard in the president's budget that there are, I think I heard 50 billion projected in additional stimulus if his budget passes. And we don't know if that's going to be tax return related or if it's just going to be extension of unemployment or whatever. But just know that this stuff that we're going to talk about next has not been around for 40 years maybe, or maybe some of it's 6.
Okay. How many of you have heard of energy credits? Yeah, most of them. Depending on the year, anything from there's been credit for anything from putting energy efficient windows and doors, insulation, or whatever in your residence, in your business, and apparently, if nothing happens, that's going. The adoption credit we've already talked about. Educator deduction is apparently going. Teachers, teachers' aides, anybody else that works in a school with kids that has expenses, they buy supplies or whatever. For a long time, they've been able to claim a $250 adjustment for those income for those expenses, and that's apparently going away. Mortgage and insurance premiums. Now, this is not mortgage interest. This is mortgage insurance, and that's apparently not going to be deductible unless something changes. So.
Another item that's going away apparently is on the Schedule A itemized deductions. We have had a sales tax deduction. I'm not talking about the one if you buy a new car, there's a little bit of deduction. I'm talking about, and fortunately, in North Carolina, this is not as big of an issue. We won't lose quite as much as states that have no income taxes, like Tennessee and Florida and Texas. But anyway, your sales tax deduction, it was either or. You're allowed to deduct the state income taxes that you paid during the year off of your federal taxes. Or if you're retired, low income, low taxable income, and you don't have much of a deduction there, then you're allowed to take, based on your income, a sales tax deduction. Anyway, that's going away. Another one that is going to be hurtful to businesses is the 15-year depreciation rules are going away. That was very helpful for those of you in the restaurant business. There was a 15-year depreciation rule for leasehold improvements, which normally would have been, a 40-year. That was a help. That's going away. There was 15-year depreciation for certain leasehold improvements, and also for qualified retail improvements. So those will go back to the old rules. Some of you probably in your business used bonus depreciation. That was a way for the government to stimulate us to make purchases so that we could write it all off in the first year. I'm not talking about the 179, just the bonus. That's going away. Or excuse me, it's not going away. It's being reduced to 50% versus 100%. So there was an opportunity for people who had an IRA and they wanted to make a contribution. They could choose to reach into their IRA, give the church or any other charitable organization a sizable gift. They wouldn't get a tax deduction on it, but it would be a way they could meet their minimum distribution requirements for their IRA, help the church, and you say, well, why would they do that if they didn't get a deduction? Well, under the old rules, they would have had to make a withdrawal of, say, $100,000 from their IRA, pay tax on it, and then get what's left over to the church. So that was a real nice benefit to charities. Again, that's going away.
And then I'm going to cover the last three, but what they just covered, remember, those expired at the end of last year. So Congress did not do any, that really doesn't have as much to do with what we're facing now. Now, whether they'll, we can't even print out a draft 1040 for 2012 if we wanted to. The IRS has not issued that because they're not sure still if Congress may toy around with some of these on that list. So if y'all are expecting to file your tax returns early and if you're due a refund, you might want to plan for that to maybe be March. I don't know. Anyway. Okay. Just the last couple. Higher education costs. This one goes back to what it used to be when we had the Hope and Lifetime Learning Credit. I'm not going to go into a lot of detail. If you're a freshman, if you or your children are freshmen and sophomores, it's going to mean probably a reduction of $1,000 of what you were used to in prior years. If they're juniors and seniors, it could be as much as $2,000 less because you can't take the American Opportunity Credit will go away. Big one on personal residence. If you do a short sale or something that causes you to have debt from your mortgage forgiven, we've been able to enjoy the fact that that can be excluded just because it's your personal residence. That goes away, which means if that happens to you, your indebtedness that you can't pay off for your mortgage could trigger a taxable event. And in our economy, that one's going to be scary if that actually happens. The final one, I don't know if y'all noticed when you filed your tax return, but last year, but you got a 2% reduction in your self-employment tax. Employees got a 2% reduction on their paycheck. That goes away, and we're back up to the traditional 15.3%. So, Aren't we just full of happy news? Isn't this Merry Christmas? Joy, how are we on time?
We've got about 5 minutes, and then I've got some announcements to make, and then we can do a Q&A section after that.
Okay. Okay, we just have a few tax planning things.
Yeah, our last question that we were just going to get is tax planning. What might you consider? I'll take the first one. Might want to consider, since the tax rates on capital gains most likely going up. If you got a stock or security or real estate, good luck with real estate. But if you want to sell and you're going to have a gain, you might want to speed that up and do it before the end of the year. Is one thought. A tougher thing that's going to happen in 2013 is, now this doesn't have anything to do with the Bush cuts. This goes back to Obamacare. Part of the way that we're going to pay for that is a 3.8% Medicare tax on investment income for high incomers. Well, you say, well, my income's not that high, but if you sell a nice piece of real estate or a nice chunk of stock, it could push you into a higher amount than you would owe, in addition to all the normal taxes, an additional 3.8%. So again, if you did that this year, that wouldn't apply.
Another issue is, what if you're considering buying a major piece of depreciable equipment for your business? On the one hand, you might say, okay, let's put this in 2013 so that higher taxes for that year you'll be saving that. You may need the savings then more because rates will be up. On the other hand, because of some expiring provisions, if you did it in 2012, you'd get a bigger chunk right away. So it's kind of a balancing act. When do you need your savings? And that's really an individual thing that I couldn't answer for you without sitting down and talking to you about your specific situation, which is why, by the way, if you are not in the habit of having a talk with your tax person about this time of year every year, get in that habit.
Because it depends, and it's always maybe. Okay, we're going to end this on a happy note. This year, our House and Senate in North Carolina passed a new North Carolina small business deduction. Have y'all heard of that? Anybody heard of that? Oh, good. You're going to like this one. All right. You can deduct, if you're self-employed, I'll start there. You can deduct, or a partnership, and have pass-through income on your K-1 up to $50,000 per owner, which means that if you're a sole proprietor and your net business income was $50,000, you can exclude that from North Carolina. So at the minimum tax rate of 6%, that's $3,000 savings. Is that right?
Yeah.
Yes. Okay. If you're married and both of you have a business, you can double that. All right. It pertains also to S corporation owners, but no wages. So if you're an S corporation, you're taking out your salary like you should, but the rest of the income is passing through as, and you're taking that out as distributions, then it would apply to that portion of the income. So North Carolina actually has given us a little money, and that's a great thing. So happy days, you got something today.
We've normally been able to deduct the interest paid on our mortgage. Is that also going away? It's not in here, right? Something else you're thinking about doing?
The question is mortgage interest still going to be deductible? And I think that I'll let Edwin talk about that, because I think you're confused with the mortgage insurance premiums.
Yeah, mortgage interest is not currently threatened. That is for 2012, 2013, probably 2014. I think you can bank on current rules. There are people in Congress who do want to make some adjustment, and you'll hear everything from this person wants to totally eliminate it, to that person wants to means test it. In other words, if AGI is above a certain amount, maybe it gets limited, or maybe we want to lower the amount. Currently, you can have up to $1 million in most cases of debt, and some people want to cut that or maybe eliminate the fact that you can currently have up to 2 residences. But for the short term, I don't see anything changing. For the long term, I don't know what's going to happen.
And I would just add to that, a lot of you may have mortgage insurance premiums that show up on your 1098, and some of them are significant. It's just not going to be deductible in 2012 unless they change it. We'll do guidance.
On the 3.8% tax on the sale of the house.
Right.
Is that off of the gross value, or is that off of? You said it's a limit of over something over 250 or something.
Right.
So if you owed 200, you sold it for 250, then is it paid on 50 or is it paid on 250?
Okay. The question is on the 3.8%, talking about a personal residence. When do you start paying tax? Well, number one, it's
not necessarily personal residence, any place.
Oh, okay. Well, any piece of property, the gain is what you're going to pay the tax on. Not what you owe, but what you paid for it, or what your basis is versus what you sell it. Now,
do you take a deduction for the loss?
No, personal. Well, not if it's business property, yes, but personal property. You got a piece of land next door to your house. Personal losses are not deductible. Now, I will say they haven't taken away the exemption amount on the personal residence, and that is the amount of money that you make on the sale of a personal house that we live in. For a single person, you can exclude the first $250,000 of gain. For married, for dual owner, $500,000. We still get that on the personal residence only. So the 3.8 doesn't come into play on the personal residence until after a couple, let's say, made $500,000 profit.
What are your gentlemen's opinions on the flat tax? Do you think it will ever get through here in this country?
It's from Satan. We don't believe it.
Of course not.
We have a joke in our office. IRS has been working on tax simplification for about 25 years now. And every time we hear that the government is entering into a tax simplification plan, we just roll our eyes and laugh because it means more customers. They inevitably make it more complicated every time they do it. So I don't see it.
Yes, sir.
Somebody, we're at the beginning of December. If somebody had to or wanted to file income tax early, are we going to have forms to do it? What are going to be some of the line items that you detailed here? And by the way, very well done. And if Congress changes anything and we've already filed, what do we do?
Last part is easy. What do you do if Congress changes the rules after you have filed? You file an amended return. Now, as for what can you file? You cannot file a return ever until January 1st for a calendar year taxpayer until January the 1st of the following year. You also, as a practical matter, cannot file ever until the forms are available. And I can't tell you when the forms are going to be available. They will be available when Congress says we think maybe we've mostly stopped tinkering with the rules, the IRS will produce forms, and until then it won't. And if that means it has never happened that we've extended the filing deadline because of the government dithering over the rules, but I think that could conceivably happen at some point.
Yes. The changes you're talking about are for tax year 2012, right? They're not going to affect 2011.
Well, we don't know that.
You don't know that.
That one section
Does
there.
it depend?
Yes, maybe, and it depends. Yes. I wanted to add something to what Edwin said. You know, as electronic filing and computer software came along and became more prevalent in the filing of people's tax returns, that enabled Congress to delay further and further into the year, just assuming that all the software people and the IRS had to do was just, push a couple buttons, and then all of a sudden it'll be fine. So this has been happening probably over the last 10 years where it comes down to the wire. Well, this time, you ask about the forms, and I think I said at the beginning, I don't know about y'all software. When I look in my software and I go to print out a draft 1040 form, it says not available to print, still waiting for whatever from Congress. So there's still lines on there that show some of these things that may get extended for 2012 or may not. So it's pretty crazy. So somebody else?
On this paper says, for a couple of different, it says, inapplicable against AMT or reduced. What is AMT?
Well, I will say that, AMT it's an alternative tax system. And you've heard Congress or people on TV talk about they think there ought to be a minimum tax on the wealthy, pay 30%. Warren Buffett said something like that. That was an attempt years ago. It might have gone back to '86. It's old. But it was an attempt for the people, and it's more the wealthy people who have the ability to buy deductions, if you will, and so they get their tax rate way down. The alternative minimum tax it reduces or limits those preference items, they call it, that are great tax deductions. And so if you have a lot of itemized deductions, contributions, and various other things making business depreciation, then your tax would have been X amount, but when you throw it into AMT, it's more. So it's been painful, and Congress has never done a good job of upping the amount of those preference items for inflation. So, but we've been having a patch. Every year they've come in at the last minute, and they still may for 2012, and patch this thing and raise the ceiling on those preference items. But if they don't, I think the preference right now is $40,000
for a single. Yeah. It's going to hit.
And last year it was $74,000. So that means another $30,000 of your income could be taxable. Same scenario from last year. It could cost you $7,500 on your federal return if nothing's done.
It's really a train wreck, and we're not kidding. It really is.
Yeah, Howard Shannon,
We're going to sing Kumbaya.